If you've been keeping up with the news, you've likely noticed that a lot of billionaires, analysts, and economists are warning us about an impending financial crisis. From Warren Buffett and Charlie Munger discussing housing market speculation, to Michael Burry, the investor behind The Big Short, wagering $1.6 billion on a stock market crash, and Barry Stern, a highly successful real estate investor, predicting an economic storm, it's no wonder that 70% of Americans believe a recession is on the horizon. So, how can we prepare for the next recession? How can we navigate through the upcoming crisis and potentially get rich? Well, we only need to follow the 7 key principles to get the most out of a recession, and we'll talk about that in today's video. While the prospect of a recession may seem alarming, recessions are actually a normal part of the economic cycle. Looking back at the historical record of recessions in the United States, we see that they have occurred regularly throughout history. Prior to the establishment of the Federal Reserve, recessions were even more frequent, typically following around 2 to 3 years of economic growth before the economy cooled down in preparation for its next expansion. However, with the interventions of the central bank, particularly in the form of monetary policy, longer periods of economic expansion have become more common. In fact, we recently experienced a record-breaking 10 years and 8 months of economic growth. It appears that we may have reached a peak in relying on the Fed's policies to stave off recessions, especially given the recent downturn. However, by understanding the dynamics at play and implementing strategic financial planning, people can position themselves to weather the storm and potentially even benefit from the challenges presented by a recession. But how exactly can you do that, you ask? Well, here are the 7 key principles to follow to get the best out of a recession. Rule number 1. Don't abandon the cash. When tough times loom, having cash on hand acts as a safety net. Take Warren Buffett, for instance. He's known for his conservative approach, holding significant cash reserves for opportune moments. To prepare for a recession, start by trimming unnecessary expenses. Supply chain disruptions further exacerbate rising costs, potentially lasting a year or more. Prioritize saving. It's your strongest ally during economic downturns. Financial prudence outweighs expertise. Maintaining fiscal stability, especially amid uncertainty, rests squarely in your hands. Rule number 2. Invest in liquid businesses. During challenging financial periods, many businesses face significant struggles, and some may even face closure. It's important to remember that employees rely on these companies for their livelihoods and supporting their families, making it challenging for businesses to function without sufficient funds. When considering investment opportunities, it's prudent to select companies with ample reserves. For instance, companies like Apple and Microsoft consistently maintain substantial cash reserves, prioritizing financial stability even as prices fluctuate. They understand the value of preserving liquidity to weather economic downturns. You can assess a company's financial health by reviewing its financial reports, particularly the balance sheet. This provides insight into their available cash reserves, crucial for enduring challenging times. However, it's essential to recognize that not all companies will possess the same level of financial reserves as industry behemoths like Apple. Rule number 3. Find the opportunity in a recession. Although it may appear daunting, starting a business during challenging economic times can yield unexpected opportunities. When the economy thrives, competing with established giants proves difficult. However, during downturns, when large corporations face their own challenges, startups often find room to excel. WhatsApp, for instance, emerged amidst the 2009 economic crisis and was later acquired by Facebook for a staggering $19 billion. Similarly, Uber, founded in the same year, now boasts a valuation nearing $50 billion, despite limited profitability. Numerous other success stories such as Pinterest, Venmo, Slack, Square, and Bitcoin underscore the potential for innovation and growth during adversity. Although it's daunting, navigating adversity can foster both business success and professional growth. Rule number 4. Don't cash out. It's easy to maintain patience when investments are growing. For instance, if you bought Bitcoin at $1,000 and witnessed its rapid ascent, you likely experienced substantial asset growth. However, the opposite occurs in a bear market. Many individuals panic and sell off their investments, fearing impending doom. Yet history shows that markets endured various crises, including the Great Depression, World War II, recessions, and wars in Vietnam and Iraq. The investors who profit are those who either sell before a crash, An arduous task given the unpredictability of timing, or remain patient until the crisis subsides and stocks begin to rebound during the expansion phase. Rule number 5. Benefit from the gig economy. During a recession, traditional job markets can be challenging, but the gig economy, characterized by short-term contracts or freelance work, often thrives. You can capitalize on this trend by offering your skills and services online. Whether you're a writer, graphic designer, web developer, or have expertise in various fields, there's a demand for freelancers. You don't need to be an expert to start. Offering services at a lower price and gradually increasing rates is a viable strategy. Embracing the gig economy allows you to convert your skills into a recession-resistant income source while maintaining flexibility and adaptability in a changing job market. Explore freelance platforms like Fiverr and Upwork to discover opportunities easily. Rule number 6. Avoid debt. If you haven't prepared for a recession, you're likely to face big challenges. Many people accumulate debt when they struggle to meet their basic needs, and during a recession triggered by a financial bubble or inflation, the Federal Reserve may raise interest rates to curb the bubble, making debt more expensive. For instance, in 2007, at the height of the housing bubble, the Fed raised rates to 5.25%, resulting in higher rates for consumers. Similarly, during the dot-com bubble in 2000, the Fed raised rates to 6.5%. Consequently, recessions exacerbate wealth inequality, as poorer individuals, who often struggle to save money, may resort to borrowing to cover necessities, while the wealthy can capitalize on excess cash to seize opportunities arising from the crisis. Rule number 7. Think about investing in precious metals. When economic uncertainty arises, consider investing in precious metals like gold and silver. These metals tend to retain their value when other investments falter. You can invest in them by purchasing physical gold or silver items, or through related options like ETFs or mining company stocks. The appeal of these metals during tough times lies in their inherent value. Gold, for instance, is scarce and requires significant effort to mine, making it inherently valuable. It is not reliant on economic fluctuations like some other investments. Many people view gold and silver as a secure way to store wealth when traditional investments appear uncertain. Moreover, these metals have global appeal, unaffected by the economic situation of any single country, making them a prudent choice during worldwide economic downturns. And that's about it for today's video. Is there any other advice that you follow during a recession? Let us know in the comments below. While you're at it, do give this video a like and subscribe to the channel. Thank you so much for watching, and we'll see you on the next one.